All right, today, the SEC has voted to approve new climate rules requiring publicly traded companies to disclose material risks posed by climate change to investors. The new rules are somewhat watered down from what was proposed 2 years ago. Here to discuss that and more is SEC Chair Gary Gensler. Chair Gensler, welcome. Good to have you with us.
Good to be with you, Tyler and Courtney.
I'm going to get to the climate rules that have just passed recently, but I want to begin with this news from involving New York Community Bank. I wonder what, if any, role the SEC has in ensuring the soundness of the bank and that the bank is in compliance with all securities regulations and disclosures with respect, for example, to having to raise more capital.
Tyler, of course, I think your viewers would understand me not commenting on any one particular company, but if I could just say generally, we have a role with regard to public companies, and most of the largest banks in the U.S. are public companies. And so it's really our role is about those disclosures they make and that they're making disclosures and have proper controls around those disclosures. And I know we'll get to climate in a moment, but that which we'll talk about in climate is also disclosure-based. But here, any one bank that's a public company, we have a role with regard to the accounting, the disclosures, and the controls around those numbers.
So when something like this happens, when a bank says we have to come into the public market to raise additional capital, take me inside the SEC and tell me what's going on with you and your employees to make sure that all of the disclosures are, do you go into a kind of overdrive here? Do you say, well, we better start looking to see whether they've complied with all the disclosures that are required here, or what? What happens?
Well, again, you'll want to pull me into the news of the day, but if I can step back from the news of the day, we have a division of corporation finance. It has hundreds of people in it that do disclosure review, and they look at filings. And if a company's going public for the first time, there's a long, more detailed review of it. If a company is already public and they're making filings, then the expert staff look at that. And we have an office in that disclosure review team that also looks at the accounting and asks pretty important questions of the issuers about their accounting and their controls. And if you look back, because this is public, I can say, you look back at something like Credit Suisse 2+ years ago, our expert staff was really asking, do you have the proper controls around your accounting? And as it turned out, they did not.
Yeah, well, you've answered my questions. I'm going to move on now to the climate change rules that have just, I gather, been passed within the last couple of hours. Straighten me out here as well, educate me. Do these rules apply to the risks that companies may face from the effects of climate change, or the risks that the companies pose in doing their businesses to the climate?
The Securities and Exchange Commission is merit neutral. We're agnostic with regard to climate risk itself, but we have a role to play about disclosures made by companies. So the rules we adopted today are about, I think, the first of what you said, Tyler. It's about investors making investment decisions and what risk it poses to investors. And it's grounded in materiality, a multi-decade-old concept that companies disclose that which a reasonable investor would consider amongst the total mix of information in making just an investment decision or voting. It's not about the climate itself.